ParsonsTradingToolbox.com presents Important S&P Analysis, a critical reversal forecast. Disclaimer required by the CFTC. If you risk it, you can lose it. The S&P index, as well as other stock indexes. What does the future hold for it? Have we reached the top and are we about to enter a bearish market, or can we expect the market to continue to grow? The answer to those questions can be found in the geometry of the market, and we're going to talk about what we can expect very shortly. For the moment, let's just take a look at the monthly chart and see what is quite obvious to anyone who knows anything about technical analysis. First off, we can see that we are basically at a double top. At the same time, we are still holding an uptrend and maintaining a trend line. So obviously we are in a critical point within the market. So what can we expect from here? Well, before I answer that question, I want to first off talk about my qualifications and the ability that I have and how I'm able to use the geometry to predict the market. My name is Michael Parsons, and I have been predicting and forecasting the market for well over a decade now and teaching others to do the same. What's unique about my approach is that it's based on the geometry of the market. It's not based on astrology, Gann, Fibonacci, or practically any other technique that you've learned for trading the market. It is actually based and has its origins in wave science and wave science or wave analysis techniques. Because it is scientifically based, the predictions that I have are usually quite dramatic and astounding. Some of those have been made publicly. For example, this prediction that I made back on July 4th, 2007. If you look at the prediction, and remember that this is a brief post, so it doesn't contain all details about forecasts that I would be giving to my students, note what I say. First off, I state that I was expecting or looking for an immediate target of 1546, and a reaction will occur at that point. If you look at the chart itself, and go back to July 4th, which would be right here, note where we reached or reacted to, and the price level at that it occurred. Right here, which was 1546, exactly the price level that I predicted. The reaction, well, was pretty dramatic, as you can see here, although it did rise up a little higher one more time. Even more important was the predictions that came after this. At that time, I was also predicting that while it may end up looking pretty bad after it hits this level for a few weeks, the down move would hardly be called a crash. So obviously I was predicting that the market would decline for the next few weeks, and that it did, as you can see here. Even more than that, I do state and refer to the volume numbers as being high, which it was, among the highest that we've had in a long, long time. Still, the prediction goes further. This is even more important, because after this I expect that this market will regain strength and move toward higher ground, eventually moving this market to top out again around 1600 plus or minus. I am looking for this level to be hit in early October. Now what do we see happening? Well, the market did indeed climb close to 1600. It was a little shy, but then again I did say plus or minus. At the same time, and even more important, was the time period that this occurred, early October. And you can see the decline that we've had afterwards. Remember, I did say it would top out at this level. So you can see how dramatic this prediction was. Now I'm not here to share this or reminisce about some successful prediction. I'm only stating this in order to actually demonstrate my qualifications in forecasting the market for what I'm about to say next. So what can we expect out of the S&P index, or for that matter, any of the U.S. stock indexes? Well, let's take a look at one of my charts. This is the S&P E-mini, and this is a market I prefer to trade. And let's look at a few of my notes and see what we can glean from them. The thing that I want to point out are these vertical lines that you see here, in particular the blue. Now these lines are reversals. The yellow are daily reversals, but the blue here are weekly reversal times. And they're important because these particular reversals are so strong that they can be seen and calculated actually off the monthly chart. So that means that we expect a rather dramatic impact on the market. When are these reversals due? Well, the first one here is due by the week ending December 7th. So sometime during that week, we will have a reversal that will set a high or low, and we should see a dramatic reaction in the market. Currently, we already have one daily reversal set at December 5th, so likely this will be the high or low of that week. We may have another reversal show up prior to arriving that week, based on the market geometry, but currently this is what we have to work with. Even more important is the second reversal. That's due by the end of the week of December 28th. Why is this more important? Well, first off, there's not a lot of time between this weekly reversal and this one. So there's not enough time to really have that much of a dramatic movement or change or action between the two reversals. Likely there will be a dramatic or sharp reaction, but still, you have only so much time to work with. This one's more important because there isn't another weekly reversal for some time, meaning that this will set the stage for basically all that follows for some time, possibly throughout all of 2008 and perhaps even beyond. That's how dramatic this reversal actually is. So whether this sets a low or high will determine what we expect of future activity. Now, I'd love to say that this will be a reversal low. If it is, well, then you can expect a continued bullish market. If it is a high, though, well, then we would expect a decline. At this point, based on just a time sequence or time factor, we don't know whether it's a high or low. We would determine that based on what happens just before the reversal time arrives. If the market's moving up higher, well, then we expect a high. If it's moving lower, then we expect a low. But we do have other factors in our analysis that we use to predict market activity. For one thing, we've already reached a monthly price level target, and therefore we were and have been already expecting the market to decline. Secondly, there are other factors that we're looking at that are pretty critical. For one thing, the way the geometry is based on short term and how these reversals are likely to come in. So sad to say, I'm actually expecting a reversal high. Now there is a possibility of an inverse here. An inverse, if that should occur, I will come back and discuss that and explain that to you and what that means for the future activity of the market. But that would mean that this weekly reversal would be a low. If it is, as we expect, a reversal high, what does that mean for the stock market? Well, let me show you my monthly chart and you'll get an idea. Do you see this target way down here, 825? Yes, I'm afraid that's the target I have on the downside. Now that doesn't mean you should panic at this point, because we're not talking about this happening in 2008 or even 2009. We're talking about several years before it reaches this level. What's interesting to note is I look at the target and I look at the situation of the market. Well, we have similar highs, and this is actually a similar low as what we had prior back in 2002. So the target itself tells me that likely several years from now we will look back and say, oh yes, the stock market was in a trading range. How obvious. Shame we couldn't have seen it earlier. Well, that's what it appears to be from what I'm looking at now. For the moment, it is important to note that this target is not based on any hypothesis regarding a trading range, but rather on a geometric target based on the market activity. And that target, well, as you can see, is a pretty substantial decline, even if it takes a substantial amount of time, like several years, to occur. If by chance we have a reversal low, well, then we are looking at a different situation. But if we have the high as expected, well, the rule is, I'm sure you have heard the expression of the January effect. And unlike many years, in this case, it may in fact prove true. If we have a high in December, at the end of December, and the market declines in January, well, then likely will continue to decline. If we have a low in the end of December and the market in January begins to climb, well, likely it will continue to climb. So please, you might want to take note as to what the market does in early January, because it may very well dictate what we can expect throughout the year. Now, none of this is meant as a trading recommendation, but just my analysis, my observation, an explanation of what I will be doing or using for my decisions and trading in regard to the future. In any event, I hope that you have good trading next year, a very profitable year, and wish you all the best.